While crude oil's regular DR session presented a low probability trading condition, gold delivered exceptional trade opportunities in both the overnight and regular DR sessions. Let's break down some incredible IDR basic trades from last week. The first one is on crude oil futures, Tuesday's price action review, identifying a low probability condition. Tuesday's regular DR session presented a short confirmation, but the real question is, was this actually a high probability trade setup worth risking? Let's break it down. Looking at the bigger picture, the aftermarket and overnight DR sessions initially formed a DR upside model. However, things took a turn when the regular DR session turned and violated the overnight DR lows and ultimately broke the DR upside model. This specific candle right here confirmed the break, shifting probabilities away from a DR upside expansion model and instead increasing the likelihood of a DR range expansion model or a trumpet-like price action throughout the rest of the day. With the short confirmation now in play, the ADR lows became a classic low-hanging fruit target. But here's the issue. The distance from the current price action to the ADR lows was so minimal that it already restricted the available range, making it difficult to execute a trade with an optimal risk-to-reward ratio. This alone was a red flag. To make things worse, a daily gap imbalance had formed just before the aftermarket defining range, stacking on top of the existing aftermarket DR session intraday gap imbalances. These imbalances acted as additional barriers, further reducing the probability of a strong downside move. The chart itself paints a clear picture. There simply wasn't enough space for a high-quality trade. Even with previous DR session levels highlighted, there was a possibility of a setup forming if price retraced into these levels, aligning with the IDR lows. However, even when targeting the one standard deviation level, the trade would offer less than a 3R potential if stops were placed correctly to cover key levels. This meant that the reward did not justify the risk, making it an unfavorable setup. Ultimately, even if this trade had been executed, price struggled to close lower and push further down. The initial trumpet-like price action had already played out, reducing the likelihood of additional expansion. Hopefully, this breakdown clarifies why this particular regular DR session presented a lower probability trading condition. Recognizing these setups and knowing when to stay out is just as crucial as identifying high probability trades. The next one is on gold futures, Monday's regular DR session, a continuation of the DR downside model. Gold futures presented some textbook DR characteristics throughout Monday's price action, delivering clean opportunities for those closely tracking the DR downside model. The overnight DR session had already offered a solid trade setup, rejecting the DR high in combination with the previous DR session level from earlier days. With the DR downside model intact between the aftermarket and overnight DR sessions, price continued to respect the structure, failing to violate the aftermarket DR highs. Instead, it found resistance at another well-aligned previous DR session level, reinforcing the strength of the model. Already at this stage, it's evident just how impactful previous DR session levels can be when it comes to anticipating price movements. For the regular DR session to maintain downside momentum, it was crucial that the overnight DR session highs remained intact. A violation of this level would have increased the likelihood of a DR range expansion model, or even a trumpet-like price action playing out over the course of the day. As the regular DR session formed and confirmed shorts with a higher probability, the DR downside model remained fully intact. This confirmation increased the expectation of further downside movement toward new standard deviation levels. While there was still a roughly 20% probability of a DR fall session, key levels such as the overnight DR session low and the overnight DR mid provided additional barriers, reducing the likelihood of price invalidating the downside move. With the session set up, the focus now shifted to waiting for a retracement into the defining range, looking for clear rejections at high probability areas. Having previous DR session levels toggled on and off as needed ensured that all relevant price zones were properly accessible. Half an hour after the confirmation, price provided a textbook rejection at the previous DR session levels, perfectly aligning with the closing price. 3 consecutive rejections in this area signaled a high probability setup, offering a clean trade opportunity with a target at the 1 standard deviation level. This session was a perfect display of a DR downside model in play, with several well-defined opportunities to capitalize on a structured decline. Number 3 is Bitcoin. Saturday's overnight DR session, an old DR level giving strong confidence for a trade setup. This trade is yet another prime example of how preparation and detailed analysis lead to high-quality setups. The relationship between the aftermarket and overnight DR session should be familiar by now, strongly hinting at a potential DR downside model. The overnight DR session opened and closed well below the aftermarket session, maintaining respect for its levels, a clear indication of downside pressure. With the short confirmation, the probabilities of continued bearish price action significantly increased. Now here's where things get even more interesting. A previous DR session level from a week earlier played a crucial role, aligning perfectly with the current defining range. These historical levels should never be overlooked, as they add an extra layer of confluence when preparing for a potential trade setup. With that in mind, identifying a solid stop-loss level was straightforward. If price retraced into the lower portion of the defining range, the stop should cover both the opening price and the previous DR session level. If price moved beyond that zone, waiting for a deeper retracement into the retirement setup area would have been the better play. As price slightly retraced, it rejected the IDR low 4 times, an important signal that justified considering an entry. However, with the initial setup offering less than 3R when targeting the next standard deviation level, patience was key. A few minutes later, the same trade setup remained valid, this time offering an almost 4R potential, an ideal opportunity with plenty of time to execute. Previous DR session levels, especially when aligned with other critical areas, should never be disregarded. They not only provide confluence but also help anticipate directional bias once broken. This session was a textbook demonstration of how these levels contribute to high probability trade setups. Number 4. Crude oil futures. Friday's regular DR session, a DR downside model got broken. This setup provides a classic example of how the DRI-DR intraday cycle unfolds from a range contraction model into a potential range expansion model. With the aftermarket DR session forming inside the previous day's regular DR session, the DR-IDR intraday cycle started with a DR range contraction model. Once all 3 DR sessions formed, the price action became more telling. The previous day's significant low had been taken out, aligning with the characteristics of a DR downside model. Ideally, a short confirmation followed by continued downside movement would have been the most favorable scenario, bringing up the red DR box and strengthening the downside probability. However, price had other plans. Just minutes later, a long confirmation occurred, shifting the session's probability entirely. Now the likelihood of price closing inside or above the defining range sat at 80%, leaving only a 20% chance of turning into a DR false session. This confirmation forced transitioning the focus toward long setups, but with caution. The overnight DR session highs remained a crucial level to watch. If breached, it would break the DR downside model and open the door for a DR range expansion model or even a trumpet-like price action throughout the day. Looking at additional confluences, 3 intraday gap imbalances lined up within the session, with the lower ones tracing back to early January's price action. These could be toggled on and off when needed for reference. 2 previous DR session levels also aligned with the current defining range, making them critical areas to monitor. Immediately following the confirmation, price retraced back into the IDR high and a previous DR session level, showing strong rejections, a valid entry point. Unfortunately, this position would have resulted in a stop-out. But here's where the trade became even more interesting. The overnight DR session mid was breached, further weakening the DR downside model and increasing the probability of a DR range expansion or trumpet-like price action. While the DR downside model wasn't fully invalidated yet, stacking probabilities in favor of long setups became the logical approach. Price retraced deep through the defining range, stopping perfectly in the retirement setup area. A rejection from the IDR low and an intraday gap imbalance provided an ideal second entry. Given that only a 20% chance remained for the session to turn into a false one, and with an intraday gap imbalance sitting just below the defining range acting as a possible barrier, This setup offered a high probability trade. No need to aim for extreme levels. Targeting the one standard deviation level sitting just below the ADR highs already provided an excellent risk to reward opportunity. And lastly, Bitcoin, Wednesday's aftermarket DR session trade. Previous DR levels adding extra confluence for upside price action. Wednesday's aftermarket DR session delivered a prime example of a well-structured trade setup with clear DR characteristics. The defining range formed, and the first hour closed bullish, marking a green DR box with the closing price higher than the opening price. Moments later, price reinforced the bullish momentum with a long confirmation immediately reaching the one standard deviation level after. With probabilities already stacked in favor of further upside, there was an 80% chance that price would either remain inside the defining range or extend higher to new standard deviation levels by the session's close. This probability became even stronger when highlighting previous DR session levels. Two of these were located just below the current defining range, acting as additional structural barriers for price, increasing the likelihood of a continuation. Now, with the session fully prepped, it was time to wait for a retracement back into the defining range with clear rejections from key levels. Right on time, price delivered 3 consecutive rejections of the IDR mid, presenting an ideal trade opportunity. The stop loss was placed strategically, not only covering the beginning of the retirement setup area in case of a secondary entry, but also protecting the defining range closing price. With multiple confluences aligning, there was no hesitation, just a well-planned high-probability execution. A textbook example of how structure, probabilities, and confluences come together in a perfect DR basic trade setup. That's it for today. Make sure to like for more episodes, and I hope to see you in the next video. Have a good one. We're gonna take on the world.